Hello, everyone, and welcome to tonight's special Real Traders webinar live hangout with Chris Verhey. Hopefully, I pronounced that correctly. If you don't know, Chris has wrote more than 100 weekly columns for OptionsInvestor.com. He's conducted seminars and workshops for Invest Tools and has been a frequent speaker at investor conferences and money shows. He's previously been on the business advisory board at Northwest Nazarene University. He's been a consultant for European Investment Bank, where he taught technical analysis to their fund managers, advised their proprietary trade desk, and helped trade over $2 billion. Tonight, Chris is going to be showing us how to win with weekly options. So I believe Chris at the end will be willing to take your questions, and that's about it. So again, thank you for showing up tonight, and that's it. Chris, are you there?
Yes, Kevin. I assume everybody can hear me okay?
Yes, we can.
Wonderful. So with your permission, I'm just gonna go with it, and I'm sure I'll have some time at the end to ask questions. Quite often, I find that when someone's ready to ask a question, it's like the answer's like 2 slides away. So, I ask if you might maybe hold off with your questions, but by all means, I'm going to take some time and answer them at the end. So. Again, Kevin, thank you, and thank you everyone for attending. I know that this can be all hours of the day or evening for some of you. Again, it is my understanding this is being recorded, and Kevin can tell you how to get that. Having said that, I'm going to get right into this. My name is Chris Verhey. I'm a seasoned option trader. Here in a couple weeks, it'll be 36 years since I've been working in the industry. So I go back a long time, and what I'm going to show you is fairly new, and the reason it's fairly new is because of the way the options have changed. And what I mean that, well, we'll get into it, we'll see. All right, so let's see if this... We are actually, let me go back. We're going to use math to generate fantastic short-term trading profits. And having said that, I got to share a disclaimer that all securities used in this presentation are for educational purposes and are not to be construed as a recommendation to buy, sell, trade any of these securities. Right. Having said that, there's a good chance I have a position in some of the stocks we might talk about, and we're not doing this to have you follow my lead. We are doing this for educational purposes. There are 10,000 plus stocks out there, and one of the toughest things to do is knowing which ones to trade. And so I use a rejection system. I start with that large universe of stocks, and I kick off stocks until I'm left with a handful. So the first thing I do, if a stock doesn't have options available, I really don't care about it. I reject it. So now I go from over 10,000 stocks to about 3,000 stocks. Next, if it doesn't have a weekly option, there's not a whole lot of adjustment opportunities or not a whole lot of regular opportunities, so boom, I throw those away. So now I'm down about 300. I then look to find the ones that have a tight bid-ask spread, that have strike prices fairly close to each other on a percentage basis, and I whittle that list down, and I've got about 50 stocks or so that I focus on, and we're going to be talking about a bunch of them today. Now, understand that I have fun doing this. I write a weekly newsletter, and you guys are more than welcome to subscribe to my newsletter. And I know some of you might already be subscribers. I'm actually a professional writer. I was first published when I was 14 years old. I wrote a logic puzzle that I sold to Dell Crosswords. I've written hundreds and hundreds of articles. I've written travel articles. I've written computer software review of articles. I write, and I like to think I'm a fairly organized person. And one of the ways I keep organized is by the use of acrostics. Now, an acrostic is an acronym on steroids. An acrostic is a word that, or an abbreviation that spells a word. So I have the PULSE method. PULSE is an acrostic. P, profit potential. U, upside reward. L, low risk. S for setups and strategies. E for events, entries, and exits. Right? And I know a lot of pilots out there that have different acronyms or acrostics that they use to help remember to put the wheels down before they land. So we're going to be talking about my weekly income now, or my WIN system. And my WIN system is education. I've been doing this a long time. I teach. I consider my subscribers to my newsletter, I call them students. Right? I might be the writer, but I consider myself the teacher, and I try and educate. And so I've created a series of videos and DVDs. I write a weekly newsletter. In my weekly newsletter, I've cut that rejection list of 10,000 stocks down to about 50, which I call my watch list. I take the top 5 plus or minus from that watch list, and I make predictions for the upcoming week. And then when I write the newsletter, I review last week's predictions, right, to see how I did. My joke is, the emperor has no clothes. I'm naked to the world. If I make a pick on one Saturday, the following Saturday, I can't hide from it. I either have to confess I made a mistake, or I can pat myself on the back and say, look how wonderful I am. Right? And the beauty of it is you get to learn in real time. Right? I jokingly talked about the NFL draft being like a long-term option. Right? The Cleveland Browns took Johnny Manziel. How good an investment, what is that? Right? Well, certainly they're selling a lot of jerseys right now, but we won't know for a year, 2, 3, 4, 5 years from now if that was a wasted pick or not. With weekly options, you're going to know right away. Now, getting into the pulse method, P stands for potential, right? Potential profit. This is a MasterCard put from July of last year. It opened at 2 cents. Right? This is after the earnings. This is not before the earnings. This is after the earnings. This option opened at 2 cents and traded to over $10. That's over 50,000% intraday return. Now that shows you the profit potential. Right? Now, is that a typical trade? Well, I actually had some students that traded MasterCard on this day. They might have traded a different strike price. They made hundreds and thousands of percent on their money. They did not make 50,000%. But again, this slide is meant to show you the potential. Right? And I'd like to think it's gotten your attention. A more typical trade might be Freeport-McMoRan. Right? This is a Freeport-McMoRan FCX put option from November of 2013. It opened at 4 cents. It made it up to 35 cents before closing at 30 cents. Now this is almost a 9 times move. Right? Now, is this a more typical trade? Let me tell you, I have a student who bought this for 4 cents and he sold it for 32 cents. He got 8 times his money. So it's maybe more typical that I have a student that actually made this trade. Right? The same student, he made a trade on Tesla. Right? He bought the $155 call in January of this year. He bought 20 contracts at 60 cents. He sold them for $7.30. Right? His $1,200 investment became $13,400. Now, this particular student, here's to me, this is a little fun story. He took this money and he bought a car. Right? Now, he didn't buy a Tesla car, but this particular student was on the TV show Shark Tank, right? And he actually sold his little tiny business to one of the sharks. And I know his neighbors are all thinking he's driving that brand new car because of being on Shark Tank. And he and I both know that he's driving that brand new car because he traded some Tesla options. Right? So is this a more typical trade? Again, this is a big gain in a day. Here, to me, I think this is a more typical trade. Now, this is an email, an unedited email I received from a student. He says, great call on your updates, right, regarding Chipotle Mexican Grill and FAS, which is the bullish banking 3x multiplier stock, right? An ETF that follows banking stocks. He says, so at 9:35 a.m. Eastern, I bought 10 Chipotle January week 4, 500 puts for $1.95. And he does the math, $1,965.35 after commissions. And 10 of the FAS January week 4, 85 puts for 35 cents. And I can tell what his commission is. He's paying $15.35. He says, as the attached screenshot shows, I closed out both transactions for a one-day net gain of $6,538.44. Fantastic. Now this is a big profit in one day, $6,500 in a day. The reason I say that this is a more typical trade, let me show you his screenshot, right? Notice the day and times, right? He bought, and let me see, I think I got a tool I can draw with, right? Here's his buys down here, 9:35 and 9:36, right? 9:30 is when the market opens, right? He bought at the open. And then right here, you'll look, his sell is 1556. The market closes at 1600. He basically bought the open and sold the close and made $6,000, right? To me, that's more typical because so many people are trying to figure out when to buy an option and not figuring out or what stock to buy the option on, not realizing that if you buy the right option, the key, right? The key is to time it right. So we're going to get into some of that timing here in a second. All right, so some of you might not be able to relate to this email, his trades. Let's see about this next one here. I consider this an enjoyable email. It says, I just want to thank you for your service/newsletter. I subscribed to your newsletter last month, and to tell you the truth, I wasn't getting much out of it until this week. And this is about 3 or 4 weeks old. I should have put the date on it. I apologize. Today I bought 10 VXX 41.5 call options at 30 cents and sold 5 at 83 cents and then sold the other 5 at $1. So my investment was $300 plus $15 for commissions. This is the first time I have a profit like this, and I'm so happy. I don't know how to copy the screens from my account, but I was able to extract the data to a worksheet, and I'm sending it to you so you'll see it's true. I'm not too IT. I'm old, right? She said the files the files attached to judge if I traded sloppy or not. I'm sure I did because the options closed at $1.75. But considering that I work and don't have much time to be checking the markets, I decided to take my profits when I had the chance to check on my position. Right? Before I read the rest of it, bought them at 30 cents, sold them at $1, and they went to $1.75. She left a lot of money on the table. But as she continues, she says she's a 60-plus grandmother that is trying to make some money for retirement, which is too close, and she's going to stick with it because it's helping her. Right? More than recommendation to buy specific stocks and options, you teach us to learn to navigate the market, and that's what I like to learn. This, to me, is what I like to consider as typical. Right? I want to be helpful to you. Having said that, we're still on P of the pulse, which is profit potential. And I'd like to think by now I've absolutely proven the point that there is profit potential worthy of your attention and that other students are getting it. Well, let's try and show you how. U, upside reward. Now, most trades make a minimum of 100%. Now, people ask me about my trading record, and I got to, and I'm going to show you some of my strategies here in a little bit, and I'm going to ask you to tell me about my track record here. But I look to double, right? I look to double. My thought being sometimes I'm early on a stock, right? I think VXX right now is incredibly low. This is not me giving advice. This is just me making a casual observation. So I'm thinking about buying some short-term VXX call options. Now, if I'm wrong, I'm going to lose money, right? You hear that? I'm going to lose money. But I don't think it's because I'm wrong. I think it's because I'm early, because sooner or later, that stock, which is an oscillator, is going to move back up. So if I'm terribly, terribly wrong and I lose it all, right? The key is low risk. I'm looking to put pennies into this trade, right? Pennies, maybe dimes, certainly maybe, right? Low risk trades. And what we do is we pull money out of the market. And Pulse, right? PUL, the PUL part of Pulse is the systematic way to choose the stocks we trade. Again, we have this 10,000 plus stocks in the universe. 3,000, give or take, have options. 300 of those have weekly options, and about 50 have good math, right? I think you've already figured out by me talking about VXX, by my students talking about Tesla and Freeport McMoran and MasterCard. Hey, you know, I've just given you 8% of the short list. After we determine the stocks that have the good math, we look for a setup. Now we're looking either for a stock-specific setup or a market-wide setup. Now a stock-specific setup might be similar to what I just described on VXX. Here the stock, right, the stock made an all-time low today, and there's a darn good chance it's going to go lower, right? As a general rule, when I trade VXX, I trade its puts because the stock has a natural inherent decay just because of the way the stock is, right? For those of you unfamiliar with VXX, it's an ETN, right? Where FAS is a ETF, an exchange-traded fund. VXX is an ETN, and while it officially stands for exchange-traded note, I jokingly say that it stands for eventually trades for nothing, right? So I generally have a put bias in VXX, but stock-specific right now, I think there's a good chance that the stock will move up, right? I'm considering putting a position on. I'm not recommending you to put a position on. I'm just trying to show you how this works. So stock-specific setup or a market-wide setup, right? Our strategies, we can go with a directional strategy, in this instance, maybe a call, or we can go with a non-directional strategy, right? Last week we played Tesla after the earnings, not before. We don't buy them before, but we played it after the earnings, and we played a strangle, all right? And I'll tell you more about that here in a little bit, but it's a non-directional play. It didn't matter if the stock moved up. It didn't matter if the stock moved down. We just needed to move more than it might normally, and it did, and we made money, right? So part of it is knowing, you know, which stocks to trade, maybe when to trade them, looking for a directional bias, understanding that when the timing is right, you don't need a directional bias because the math is that powerful in your favor. All right, E. E is events. Now we can have a stock-specific event or a market-wide event. Stock-specific, I mentioned Tesla. A week ago, Tesla released its earnings. Again, we do not trade before the earnings because the options are overpriced, their implied volatility is inflated. We wait to see if the stock gaps after earnings and then we trade it. That's a stock specific. Next Wednesday, the Federal Reserve is going to release the minutes from their FOMC meeting, right? The Federal Open Market Committee meeting. 3 weeks after the day of an FOMC meeting, they release the minutes. They have these meetings 8 times a year. So the meetings 8 times a year are a good event. The minutes 3 weeks later, 8 times a year are a good event. There's 16 days that we have a statistical advantage to trade. You add non-farm payroll, which happens the first Friday of each month usually. You got those 12 more days. Now you got 28 days that you have a higher likelihood of profit than the other 200 and some odd days. Right? We look for statistical advantages. We then enter our trades. We can enter either based on the stock being at a certain price, right, buy low, sell high, or the stock being at a particular point in time. We then, after we buy, we have to exit. There's two ways to exit. We can set a target order, set it and forget it, right? Place a good till cancel limit order, hoping that the market goes to where we want. And that particularly works well if you're not able to watch. If you are able to watch, I like to have this option go my direction, then put a stop loss order just underneath it. And as the option goes higher in price, I raise the stop, right? So last week on Tesla, we bought the 190 calls at $1.50, and we raised the stop, to $5, right? The option got up to $6.60, and kind of before we could raise the stop higher, the option rolled over and we got out at $5. So we bought it at $1.50, we got out at $5, right? A target order, right? You could have said, hey, I'm going to buy it at $1.50, I'll be happy if I get 3, right? There's different ways of playing it. Again, what we're trying to do is we're trying to make money by buying low, selling high. But most people, most traders, right? Most traders, are trying to analyze which way the stock's going, right? They're one-dimensional. They want to buy low, sell high in price on the stock, right? My thoughts are we use options. Options are multi-dimensional, right? And we can profit no matter what the stock does, right? Because we want to trade the option, right? My line is historically options are traded as a stock substitute. I want you to start thinking of trading the options as an option, right? And the reason to trade the option as an option, right? Number one, how much could you lose, right? How much could you lose? We look at these options. If we buy options for pennies, we can only lose pennies, right? But the other reason is how much do we use, right? I can control a $500 Chipotle Mexican grill, right? A $600 Apple, a $300 Amazon. I can control that stock for pennies. So how much could I lose and how much do I use? Again, most people have traded options as a stock substitute. Most people have traded options as a leveraged directional play, right? A leveraged directional play. And typically what they're doing, they're using a call option, right, as a substitute to buying the stock, right? A call option gives the owner of the option the right to buy the stock at a set price for a set period of time without obligation. Call option is basically a bet that the stock is going up in price. Now, a put option, right? A put option gives the owner of the option the right to sell the stock without the obligation to sell it at a set price for a set period of time. And so if you can think of it, a put option then is a bet that the stock is going down in price, right? And it maybe I don't necessarily like to use the word bet, but it fits very nicely on the screen, right? And so one of the things we often do is what's called a straddle. A straddle is a call and put with the same expiration and the same strike prices. And if you're able to think of it this way, a straddle then is a non-directional bet that the stock will move. And we have some rules for straddles. We only buy straddles when they're at the money. Now, and it just goes into the math. I'm not going to get into the math right here and right now. Understand, in the past, right, 10 years ago, you had strike prices every $5 apart. How often will the stock be right at a strike price? Well, today we might have strike prices every 50 cents apart, so it's 10 times more likely, right? Big thing. We can also buy a strangle. This is a call and put with the same expiration but at different strike prices, right? A strangle has a lower strike price put than it does the call. You're trying to wrap around the stock hoping for a move in either direction. Again, it's a non-directional, the stock will break out. Where the straddle is a non-directional bet, the stock will move, The strangle's a non-directional bet that the stock will break out. So I write a weekly newsletter. In November, my newsletter said, quote, if Tesla gaps up, I feel the reversal has a higher likelihood of being the better trade. If Tesla gaps down, I feel the continuation has the better chance. Both involve buying the puts. As always, you can hedge yourself by trading strangles, buying both the call and the put, right? So in November, I said, hey, look, Tesla's going to release earnings. After the earnings, buy a put. But if you're not sure, buy a call and a put. So that's my Saturday newsletter. Here's a testimonial email from the 7th. It said Thursday at 9:39, I bought 5 143 puts on Tesla at 42 cents. I then placed an order to sell at $1.50. Right? This is that limit order I was talking about, that target order that I was talking about, one of the exits. He says, my order was filled 2 minutes later according to my computer. You suggested puts no matter where it opened, and it worked. So this person tripled their money in 2 minutes. That's how fast we can do this. Now, again, if they would have bought the call and the put tripled, it doesn't really matter what the call did, even if the call went to zero, because they would have made more money, right? More money than that it cost. So here's the thing. When I gave the recommendation to buy a put and the put worked, everybody sees that as a winner. But when I said, hey, you can hedge yourself by buying the call and the put moved more than the call and put combined cost, do you still count the call as a loser? That's my question. All right, testimonial the next day from a different student. As a newer student of 3 or 4 months, I had a great week trading your system. Here are my results. Bought one contract, the Tesla November 149 put for $1.38 and sold for $6. Right? One contract at $1.38 is $138. Where the other gentleman that bought 5 contracts at 42 cents, he tied up $210. This gentleman tied up $138. Again, he pulled in $6, 4 times his money in a day. Call that a good trade. An important point though, right? These are good trades. One of the things I teach, and you should know this about any system out there, any system that requires you to trade it perfectly can't be traded perfectly, and you're not going to do it. When we have moves of 3, 4, 5, 6, 700%, you don't have to get it all to make money. You just get a piece out of the middle. We call that sloppy slop. Understand sloppy slop works. And I want to graphically show you that sloppy slop works, because I'm going to refer to that first gentleman's trade where he bought the puts for 42 cents and sold them for $1.50 2 minutes later. Right? If he would have held it a couple of days, his 42 cents would have been over $10. Right? His 42 cents an option is $42 a contract that he sold for $1.50 a contract became $1,000, right? His 210 became 5,000. Is he disappointed? I don't know. Remember, he sent me that email on the 7th. He didn't realize it was going to happen to the 8th. So anyway, there's a lot of upside in what we're doing here. Now, our win system, right? It's education. I teach you all the math, how this works. And I got to tell you something. You know, I have a unique way of looking at options. I'm very good at math. Proud dad moment here, proud dad moment. My daughter is graduating college in, 4 days with a degree in mathematics. My daughter already has a job lined up for her when she's out of college. And I didn't make a phone call to get it for her. She actually got it at an investment firm that I know absolutely nobody at. And you know, if I don't know enough about math, I go to my little daughter, my sweetheart of a girl, and say, honey, help me here, right? So having said that, you know, we educate, right? I think I do a pretty good job of making presentations. We record them. Again, I'm a professional writer. I've write a weekly newsletter. I have my watch list where I got my top 5. I take the best setups of that week, top 5. Now, this is a slow week. This week, the setups is 1 stock, right? Last week, we had a whole bunch, right? Part of the reason we only have 1 stock this week is because this Saturday is my daughter's graduation. I'm going to, instead of being at my computer writing the whole time, I'm going to be celebrating with her. So I got to share the truth here. Anyway, the Win system, I give midweek updates, right? VXX was not my top 5 pick, but I sent out a midweek update yesterday saying, hey, look, here are these conditions. Get ready to buy a call, right? And if the conditions get a little bit better, you know, we'll send out the actual recommendation. Now, the Win system is more, though, than just education and recommendations on the Pulse method, right? We've been talking about the Pulse method. The Win system includes how to trade your account as it gets bigger, right? The Pulse method is really for small accounts. If you've got an account of less than $5,000, whether it's $1,000 or $2,000, or whether it's $500 or, you know, $1,400, whatever, it's under $5,000, I want you to focus on the Pulse methodology. All right, I hope they did a pretty good job of telling you what we're doing. We're looking for non-directional trades unless we have a bias. You know, we tend to be buying slightly out of the money options because they have the most gamma, and trying to get moves, whether it's a stock-specific setup or a market-wide setup, right? What we focused on there is this. I have trading systems for accounts that are $5,000 and up. I actually call it my mirror system. I'm trying to come up with a good name, but we'll see why I call it internally system. We also have the last trading system you'll ever need, and the Road to Riches, both of which are for accounts $100,000 and larger. Understanding an account of $100,000 and larger, you don't necessarily want to buy 10,000 contracts at a penny a piece, right? Anyway, so the last trading system you'll ever need. Last is an acrostic. An acrostic is an acronym on steroids. It stands for Large Account Strategy Trading. All right, I'm going to start with the $100,000 account and work our way down to the $5,000 account. Now, on November 25th, I did a webinar, and I set out publicly to give the mechanical systems to trade 1 stock, and I said we're going to trade this stock forward for a year, and we're not going to change any of the rules. We're going to buy if it does this specifically. We're going to sell if it does this specifically, and we had a number of different triggers. We had 3 different triggers, a mechanical system. So that's here in a couple weeks. That will be 6 months ago. Again, we've not changed any rules. We've not changed the stock. We're trading on 1 stock and 1 stock only. One of the triggers I call slow A, right? Slow A is up 27,455. Slow B is up 30,935. And the fast is up 30,169, right? Now understand, you can back test a system, right? When you back test a system, you can magically pick the day you start. But if you forward test, right, which can also be known as paper trading, or if you trade forward, right, with real money, you can't go back and pick the starting day. November 20 starting, and we've turned $100,000. We've got a 27,000, somewhere up to almost $31,000 in gains on these 3 different triggers. Now, one of the reasons I showed 3 different triggers is because if trigger A was at 20,000 and trigger B was at 20,000 and the fast trigger was at 50,000, something's not right, right? We need to have sort of one system proofing the other systems, and they should be within a realm of, you know, being close to each other. Now, the Road to Riches, road is also an acrostic. An acrostic is an acronym on steroids. It spells a word, and as such, it becomes a memory tool, right? And mnemonic, I can't say the word very well, but look it up. It's MENEMIC, mnemonic. Memory crutch. Road to Riches stands for really once a day, right? So On the last trading system, I can introduce you to a stockbroker that can trade those systems for you, and you can literally check in like once a month. How's it going? The road to riches, right? You can, it trades once a day in the morning at the open. You should set it up yourself because a broker will charge you too much commission to do it. It should take you 5 to 15 minutes each day. The road to riches trades the same stock. It just has a higher volatility, right? So its biggest drawdown was $4,000 instead of $2,000, right? But it's up, as of this morning, $36,370. And what these systems are, these are hedge trading. These are stock trading systems, right, where I'm using options as risk control. And these systems require a fair amount of money, right? And I need to understand the difference between money and use versus money at risk. It requires a fair amount of money, not that the money's at risk, it's just in use. And we're trying to pick up a small inefficiency in the market, right? An inefficiency that the institutional buy and hold investors, just consider a rounding error. We hedge this system, right, with a system that my intern, I have a college intern, and he was asking about hedging this thing, and I said, well, the hedge you can use as a standalone trading system, but it requires $25,000 to do it. And so, I'm always working to have a trading system require less and less money to run because it becomes more and more affordable and more useful to more and more people. And so I showed him the hedging system for the last and the road to riches, right? And he started asking some questions, and he ended up starting trading it himself. Now, he started with a $3,000 account. He did so well, he had a garage sale. He like sold everything. He borrowed money from his dad, and he raised his account up to $10,000. And in studying what he did, by not having a $25,000 account, he misses one opportunity for trading, which I think is very good, and probably the reason that stopped me from thinking that this would work for smaller accounts. But in studying all his data, now his data is not hypothetical back-tested data. It's real forward. It's not even forward testing. It's real money trading. I've determined that I can teach that system, right? That I can run that system, and I can teach it for an account that has $5,000 in it. And so I'm going to do, right? I call it internally trading because this is from my intern. I'm going to call it, unless I get a name that will become an acrostic and spell something, I'm going to call it mirror trading. And basically what I'm going to do is I'm going to take two $10,000 accounts, right? And the reason I'm going to take two $10,000 accounts is because I'm going to run them at two different brokerage firms, right? That way, if one brokerage firm has better fills than the other, right, we're not just going to assume, hey, well, you just got lucky because that broker is such a great broker, right? Additionally, by running 10,000, first of all, I want to make some money doing this, and I could do it with $5,000, but I plan on making money, and I've got the money to do, so I'm going to do it with 10,000. I'm going to do it 10,000 twice. But because the system can be run on 5,000, every trade I make, right, every trade I make will be in an even number of contracts. So I might buy 10 in a $10,000 account, therefore, a $5,000 account can buy 5. If I do 20 in a $10,000 account, a $5,000 account can do 10. If I happen to do 200, a $5,000 account can do 100. If I do 2, a $5,000 account can do 1, right? So it can be, basically I'm going to trade a $5,000 account twice as big, right? Now, I'm going to tell you this up front, there's a purpose for this. I call it mirror trading because not only are the two accounts mirroring each other, right, but you can mirror me. Now, I'm going to tell you this right up front. I'm going to trade options on only one stock. I'm not going to be searching for stocks. trading options on only one stock. I'm not going to be day trading, and I'm going to do it in my IRA account. I'm going to start actual trading on June 23rd, and I'm going to double this $10,000 account. Now, based on my intern, I'm projecting my intern is going to be up 60% because he's not as efficient as me, right? And I'm predicting he's going to make 60% a year. He's not as efficient as me. And people always ask me for my track record, and I always say it's not really what I do that counts. Look at what one of my students does, because you're more likely to be my student and get his rewards than you are to be me. Having said that, every one of these trades I make, I'm going to send out an email when I make the trade, right, saying, hey, I'm going to buy this, and here's my limit order that I'm going to put in it, and once I get filled, I'm going to put in another buy order, and I'm going to have 2 accounts at 2 brokers, because I'm going to assume that when I get filled on both brokers, it's time to make the next trade. And you will find that this is a very mechanical system. This is what I do. I create systems. I study options, right? And I care less about the stocks. I can study the option, and I can find situations where I can extract an inefficiency that the market is ignoring, right? The win system helps small accounts become medium-sized accounts by it taking advantage of the gamma in short-term options, right? It will help medium-sized accounts become large-sized accounts, right? And it will help large accounts allow you to retire. So I think they gave me a certain amount of time to speak. I talked for 3 minutes long, but Kevin started me a minute late, so I talked for 2 minutes too long. I'm going to put up the link if you guys are interested in the win system, right? Kevin, if you're there, if you wouldn't mind somehow making this link available to them. And I'm going to now go and try and look and answer some of the questions that have come across. So Kevin, if you don't mind maybe saying something while I take a drink here and go back, because there's a fair amount of questions. Well, and I'm gonna try and answer some of them. We'll get to them. So someone asked, hey, is a $25,000 account size required? No, you don't need a $25,000 account, right? It just depends on what $25,000. People generally ask that because they're talking about the day trading regulations. The day trading regulations are specifically for margin accounts. If you have a non-margin account, you're exempt from the day trading regulations. That's the first thing. Again, this mirror system, a $5,000 account, I will not day trade. I will not make a single day trade in a year in doubling that account. And again, you know, the reality of it is I'm going to make the order when it gets filled. I'm going to wait till the second account gets filled before I put the order in. There's going to be a little sloppy slop, so it might, you know, I plan on doubling it in a year. I mean, I don't know if people are going to be disappointed. Oh, darn, Chris, he said he was going to double 10,000. He only made 70%. Shame on him. Shame. I don't think that's the case, right? Someone asks, is this more like gambling? This is not gambling. This is discovering an inefficiency in the market and extracting it. The Pulse methodology finds the inefficiency. Here, let me tell you what the inefficiency is, so you don't say, oh, he just said there's an inefficiency and left and didn't say what it is. If you understand how options are priced based on what the stock changes from day to day. And the intraday range is often greater than the day-to-day change. And so in a sense, we're capturing the tails, right? The market, buy and hold institutional investors say, oh, that's noise, just ignore it. right? They're buy and hold, ignore the noise. Yeah, guys like me, we don't listen to you. We go harvest the noise. We're volatility farmers, right? We neither plow nor plant. We neither weed nor water. We just harvest. We harvest the noise that you tell us to ignore. Someone says, does your methods work for only day trades? Can it still be profitable to trade duration more than a day? Again, you know, the day trading regs are one thing. You know, we can give you more recommendations than you can handle if you want. So you do not have to be a day trader to do this, albeit you can and often trade daily, you know, or in the days. Someone said, what's the best way to buy a weekly option? Directional call, sell a put? No, we don't sell options. We buy options here, right? What do you do if there's just so few weekly options? Most options for a month usually. Hey, you know, there's 300 and some odd stocks that have weekly options. You know, 50 of them have good math. I can't trade 50 stocks on a day. A straddle is long a call, long a put, same strike price, same expiration. A strangle is long a call, long a put, same expiration, but different strike prices. Someone said buying a put and selling a call can be used if they think the price is going down. Right, that's just a stock substitute. We're not into stock substitutes here. We're trading options. Right? So the pulse method, someone asked again, what size account? Pulse methodology is anything under 5,000. The mirror trade is above 5,000, and the last trading system you'll ever need, right? And the road to riches are for $100,000. And the idea, they're going to make smaller returns, but they're going to make them far steadier with much less risk involved. You know, I'm going to talk about doing this in an IRA account. You can do it in a regular account. I'm just going to do it in an IRA account because that's the conservative way of doing it. Someone says, what kind of software do you need? You use the software that your broker gives you, right? Your trading platform. I don't recommend individual brokers, albeit I'm more than happy to tell who I use. I don't want to offend a broker that we're maybe trying to have a relationship with by not recommending them. Right? My Win system includes all these videos. It includes the weekly newsletter. It includes midweek updates, and it includes which are all educational and recommendations. Plus, it allows you to mirror my trades. Is mirror count means ditto. I'm maybe not sure what that means. Basically, mirror, I said, you know, I've come up with that because you can do exactly what I'm doing. And, you know, someone asked about no charts. The reality, when you get in the system, you know, certain event setups we don't need a chart. We buy a straddle only if the stock's equal to the stock price. You don't need a chart to know that the stock's at 50 and there's a strike price at 50, right? We get an advantage. Now, there will be times that you say, hey, I know the call's going to work, then don't buy the put along with it, buy the straight call. All right, someone's a little confused. The Win system, right, includes the Pulse system. The Pulse system is how to trade a small account, right? We have a weekly newsletter, and we give midweek updates, and in addition, I do webinars, and I send out alerts for trades. Again, the mirror system, I'm starting on June 23rd. That will give me about 5 or 6 weeks to get everybody instructed up, because everything I'm going to do, I'm going to tell you before I do it. Someone says, why wouldn't you potentially be able to double that $10,000 account in one trade having 500% or more returns? I would have no problem, but since we only, if you're a small account, your back's to the wall. You kind of have to put a very high percentage of your account in any one trade. If you have a large account, right, it's probably not good risk management to put all your eggs in one basket. Someone said, I presume you're not using Delta 70 strikes. Absolutely not using Delta 70 strikes. We look for options that have, what some people say, hey, it's a bad deal because it has a low delta, and the understanding being there that delta is the probability of an option expiring in the money, but we're not looking to hold these options to expiration. We're trying to buy a stock that has a low delta because it has a high gamma. Someone said, do we provide DVDs and training? Absolutely, we provide DVDs and training, hours and hours of them. Someone says, will you use one given stock for this year? The mirror system, I'm going to tell you this right now, on June 23rd, I'm going to start to double account trading one stock. 2 months later, I'm going to do the same thing on a different stock, and a month later, I'm going to do the same thing on another stock. Someone said, just straight puts and calls, or do you do spreads? The Pulse system is straight calls and puts. Can you buy options with a cash account? Absolutely, you can buy options with a cash account. Are your strategies directional in nature? Well, the straddle and strangle is non-directional. How far can the win Friday trades be scaled up? When we trade stuff with liquidity. That's one of the rejections I have. I'm not looking for these stocks that nobody trades, because the setup's good. Like Zillow was actually a really good setup last week, but there wasn't the liquidity there. So, I have no problem trading, 1,000 contracts on some of this stuff. But again, I think when a guy gets into a larger account, I think these advanced systems become that much more beneficial for a large account. My goal is to help you turn a small account into a medium account and a medium account into a large account. Do you use debit spreads? Tell you the truth, I will teach you how to enter a debit spread for a credit. That's not part of the Pulse. That's part of the win, though. Someone said there's a lot of theta if you carry the position over the next day. Well, if you buy at the close of one day and the very next day at the open, there's really not that much theta. Theta being the time decay. Understand that these cheap, inexpensive options, there's very little time left, so there's very little time value, so there's not much theta. Does one subscription price cover all three approaches? Absolutely. This is a package. Someone talked about credit spreads. If you think about a credit spread, if you've ever had a credit spread go against you, you've experienced gamma negatively affected by gamma. You know what? I'll stack my math up to anybody. I'll find the best credit spread guy out there, and let's go head to head for a year, right? Trade one stock only, see who makes more money. Having said that, I can trade lots of stocks. He can trade lots of stocks. I'll stand this up against any credit spread stuff. All right. Someone asked small account now. So there's a lot of emails coming here. So someone says the cost of your program is the same size whether you have a $5,000 or $100,000 account. Hey, this is true. The reality of it is I'm not selling a $100,000 system, right? Because if I did, there'd be 2 or 3 people talking to me. Having said that, the 2 or 3 people that already have $100,000, they really need this. But I have a reasonable expectation of taking a $5,000 to $10,000 account and given time to build that up towards that $100,000 account. Right? So someone asked, how's this different from my money from nothing package? The big difference is, first of all, you get the midweek updates, trade specific alerts, and on top of that, we give you these other trading systems. Someone asked, could you exit your trade partially and leave a runner? Well, if you go back and you rewatch this, you'll see that the grandmother bought 10, sold 5, and let the others run a little bit. So yes, we can do that, absolutely. All right, Kevin, you there?
Yes, I am, Chris. Just to say something real quick. Oh, sorry. Go ahead, Chris.
Well, I'm just going to say the questions are probably coming faster than I can answer them all. You know.
Mm-hmm. Yeah, no problem. Just wanted to say something, guys. So, some people have said that they have problems with the link. The link is working for just about everyone. What I would suggest you do is click the link. Don't try to copy and paste the link because obviously you can grab a space in the when you're copying it. So I would click the link, go to the page, and I would bookmark it so that you have it. So that this way, you'll be good that way.
Yeah, one thing, somebody said something that says, hey, why not have a cheaper price for the smaller accounts? The reality is you're only going to be a small account for a little bit, right? My students make money. I can, next time we do one of these webinars, I should probably get one of my students on that lost his job, kind of played with this to the point where he realized he never has to work again, and he's probably averaging $2,000 a day in trading profits. And he started small and went big, and that's my expectations is to help all small accounts become a medium-sized account, and all medium-sized accounts to become a large account. And in reality, my publisher are probably mad at me for even mentioning the larger account systems, right? Because it says focus on the small. That's what people want. And what I want to tell you is I'm going to teach you how to trade, right? I will teach you how to trade. You will learn while you earn. And, it is my expectation that your account will become bigger. And, I might, in a sense, be famous because of the Pulse system, but I'm telling you, you'll become rich with the whole WIN system. So. All right, Kevin,
Okay. You all set?
I'm running out of voice here.
Okay, no problem. All right, so guys, that's about it. Again, what I would say is click on that link and bookmark it so that you have it for when we're about to end. And also, we just want to say thank you so much, Chris, for taking time out of your day to come and share such valuable information. It was a great presentation, and we thank you, and we look forward to having you back. And to everyone that came tonight, thank you so much for coming tonight. We appreciate it as always. And again, click that link, bookmark it, and check out Chris's system.
Kevin, thank you. Thank every one of you. A couple of you guys mentioned that you were, watching in Europe in the middle of the night. Thank you for staying up with me. God bless each and every one of you, and I look forward to meeting you in person if possible. Thanks. Good night. Good evening.
Thank you, Chris, and thank you, everyone. Have a great night.